Glenn, the arch theme right now that we see is there's money, money, money out there. Everybody's talking about money up to their eyeballs. What are the ramifications in the global system of so much money sloshing around in finance?
It's a really interesting question, Tom, and there's a little bit of a paradox at work here because money is available in part because rates are so low and so money's seeking returns. But rates are so low because the authorities are worried about the economy faltering. So it's ironic that there's some of this availability as a consequence of economic problems. And the real issue becomes if, as a consequence of that excess liquidity, if there's so much return seeking that it's increasing the risk substantially.
Glenn, you're an all-shucks guy. You don't talk about your prodigious ability to judge credit as you did years ago at Chemical Bank. How do you judge the credit system right now? I mean, people talk about a leveraged loan excess or maybe this flavor of shadow within shadow banking. How do you judge the overall credit markets right now?
It's quite a good question. So I think the credit markets are obviously stretching for yield, and we're starting to see in the the leveraged loan parts of it, the high yield part of it, a deterioration in credit quality and in associated terms. The big question is whether that creates some sort of systemic risk or just the potential for market adjustment. Since a lot of this is at the corporate level and it's being not provided by deposit-taking institutions, I'm not really worried about the systemic elements of it, but I'm not a buyer right now of high yield at these levels with these terms.
Is liquidity, Mr. Hutchins, is liquidity a concern in the markets, and could that be the symptom of something systemic? We saw it with the repo market, but as we get towards the end of the year, it could also provide something ugly.
Yeah, well, no. So the issues in the repo market suggest that we've actually had less liquidity than we had originally thought. And what I think is going on there, in large part, is that as a consequence of all the complicated rules around capital for the big banks, we no longer have just required reserves and excess reserves. We also have buffer reserves. So banks keep a certain amount of reserves in buffer to manage the complexities associated with their new capital requirements and standards and stress tests. But I think we've kind of now have gotten to the point where we understand what that is. There's adequate liquidity in that market, and it seems to be working smoothly. I think the real issue in liquidity is how it comes into parts of the market which have bubble-like behavior. And I think that's actually, in addition to the high-yield sector, which Tom was asking about, can be expressed in this bubble that's happening in index funds and ETFs on the one hand, and in late-stage venture as exemplified by WeWork on the other hand.